What is going on, investors? Hopefully you guys are doing well out there. Time to take a look at different sectors here in the stock market. On today's show, we are going to focus on the chip sector. We'll take a look at Taiwan semiconductor manufacturer, TSM. We'll look at AMD. We'll look at Intel. We'll look at NVIDIA. And we'll also look at Qualcomm. Over the next couple of weeks, I'll do numerous of these videos on the different sectors in the market. As we're seeing a broader pullback in stocks, I think this creates a wonderful buying opportunity for those long-term investors or even shorter-term investors out there looking to accumulate or make a little bit of money in the stock market. There are timestamps down in the description below if you want to jump forward to the stocks that you have an interest in. And also, we have done earnings videos more recently on a lot of these stocks that are very much in depth. We look at cash flows, we look at the balance sheet. On today's show, we'll have a broad overview of the financials. We'll also look at valuation. We'll look at some of the news stories. We'll also look at earnings estimates. But obviously, I'll also have down in the description below a more detailed video that we've posted since the last earnings on all of these companies. Now, before we get into the individual stocks, if you are somebody that doesn't necessarily want to pick winners or losers in this sector, there's obviously an ETF for that. Probably the most popular in the chip sector is the VanEck Semiconductor ETF, otherwise known as the SMH. Over the last year, this thing is down big, 23%. Year to date, down 34%. If you compare that, though, to Intel, NVIDIA, and AMD, held up a little bit better than that. That is because you get obviously a more broader diversification inside this ETF. Its top holdings are TSM, NVIDIA, Texas Instruments, Qualcomm, and Broadcom. But also inside this ETF, you have AMD, you have Intel, you basically have the entire chip sector, whether they make the chips, design the chips, or make parts that actually help manufacture these chips. You've got it all inside this ETF. It's a pretty equal weighting after you get past TSM and NVIDIA, which have over an 18% holding inside this ETF. Now, more recently, the price action has obviously been in this downward channel. A lot of stocks and a lot of sectors went on this monster rally in July. We peaked out just a couple of weeks ago. We'll be looking at weekly charts on today's show. Just gives us a little bit broader overview of where we are in these stocks. This one's essentially given back about half of those gains that we've had over the last month or two. It's back testing this downward trend line on the downward channel. This is very, very typical. When you break out of the channel of a downward channel, you tend to come back and back test to at least the top of the line. I've seen we've pierced through it. I would assume this is probably coming more towards the middle of the channel, which take you down another $10 on this one. If it comes back and retests the lows and makes new ones, you should come south of about 190 on this one, likely in pretty short order. Also, on today's video with all these stocks, I'm going to put up a volume profile that's represented here on the left-hand side. If you don't know what this is, essentially what it is representing is the volume of accumulation or selling in the individual ticker that you're looking at. The longer the bar stretches means the more volume that accumulated at or near that price. Obviously, the green lines represent kind of buying and the red represents selling. And what you are going to notice with all of these stocks is they are hanging on a cliff. When you have very little volume profile, it means very, very, very few people accumulated and bought that stock at that level. And from a technical perspective, you can slice through areas like that like a hot knife through butter. And that is very worrisome for this. If the momentum continues downward on this, you have nearly 50%. I said 50% downside on an ETF that is already down year to date 34%. If you believe this volume profile, if the momentum stays out of this sector and the markets in general, you have another 50% downside going from $200 per share on this ETF down to about $100. And I think some of you are probably saying, well, there's no way this thing goes down 50%. Well, yes, this thing has been volatile in the past. Obviously, you had the great financial crisis where you went from 40 all the way down to 15. That's more than a 50% retracement. And then obviously you had this launch right around the dot-com bubble in 2000, where you went from 103 on this one all the way down to 17. That is way more than a 50% decline. You've had other drops here as well. The pandemic drop that we saw in early 2020 took you from 150 down to 90. So not quite a 50% retracement, but a pretty steep one. This is a volatile sector. I'm probably not breaking any news there, but you are going to notice as we go through all these names, they are literally hanging on a cliff. And that is your risk reward. If these levels can hold, they should be able to rebound and then retain higher prices. If they break to a much lower level, you're going to have valuations that we quite frankly have not seen in over a decade in this sector. The first stock that we're going to talk about on today's show is Taiwan Semiconductor Manufacturing Limited, otherwise known as TSM. I often get asked here on the channel because I'm always talking about Apple, I'm always talking about Amazon and Google and Netflix and Microsoft, and some of these companies have fantastic earnings and fantastic dividends, and they're known as FANG. And a lot of people wondering, what's like kind of the next step down from FANG? We already have kind of accumulated FANG. We want to accumulate some of these other companies that have equally as good fundamentals and could potentially grow alongside those stocks in the future. I would put Taiwan Semiconductor in that group. The only issue with Taiwan Semi is obviously that geopolitical risk, and I'm going to be 110% honest with you guys. I have no idea if China is going to overtake Taiwan. I have no idea if they do that, what the reaction from the Western world would be. I have no idea what the reaction would be over at Taiwan Semi. I have no idea. There is so much uncertainty. That is why I don't own this stock, because quite frankly, there is so much uncertainty. If that uncertainty gets cleared up, I'm going to show you the financials of this company. They are so good. There's only maybe 2 or 3 other companies in the world that I think are as good, and the companies are Apple and Microsoft and Google. Now, year to date, this one's down 37%. Over the last year, about the same story, down about 33%. Now, from a valuation perspective, when you see a stock like this pull back, I've got a price to sales 10-year chart on this one. We're still trading kind of north of 6.5 times sales on this one, but it's clearly not as high as it used to be when it was north of 10 times sales just last year. And for almost a decade, this stock traded comfortably kind of in that 4 to 6 times sales. So you're not getting kind of a wildly cheap valuation. When we look at Intel and some of these other stocks that we'll cover today, those stocks are at historic lows when it comes to a price to sales valuation. This one not quite there yet, and there's probably some reasons for that. One of the reasons for that is the fact that when you look out forward on the revenue estimates, Wall Street's still anticipating 33% growth for the upcoming quarter, 26% growth in the fourth quarter. Now, we're going to slow down next year on this one. Looks like to a 9% grower, maybe close to 10% growth on that revenue side. But then Wall Street's anticipating this to reaccelerate in 2024 back to a nearly 20% grower on that revenue side. Obviously, some uncertainty if this company is going to be able to reaccelerate in the back half of 2023 and into 2024 back to those high growth rates. But obviously, if this company is able to do that, and maybe we clear up some of the geopolitical tensions in China and Taiwan, certainly could be beneficial for a stock like this. Now, the reason why we continue to look at this company is these financials are as beautiful as it gets. Now, we'll focus on this far left-hand column. This is the most recent quarter. Again, down in the description below, I'll have a link to a more detailed analysis of these financials when this company reports. We always report the cash flows, the balance sheet. We go through the whole thing. On today's show, I'm going to focus strictly on revenues and profits, and you are going to see here, it doesn't get any better than this. In the most recent quarter that this company reported, we had revenues come in at over $18.1 billion. For the 6-month period, you had revenues coming in at $35 billion. Essentially, this company is on about an $18 billion run rate when it comes to that revenue. And then when we look forward on this company, Wall Street expecting $19 billion next quarter, $20 billion for the fourth quarter, and then basically between 18 and upwards of $25 billion for the subsequent quarters. And the reason why that is so exciting for TSM is they just magically print money over at this company. Look at the gross profit on $18 billion worth of revenue at TSM. You get $10.7 billion worth of gross profit. And look how little they spend on these operating expenses. On R&D, you spent just $1.3 billion. Total operating expenses, just $1.8 billion. So off $10.7 billion worth of gross profit, you spent just $1.8 billion operating the company, and you have income from operations at nearly $9 billion. So almost half of the net revenue flows down to income from operations. You don't have to fully understand business or how these financials really work out. It's spectacular when you have half of your revenue flow down to income from operations. Now you pay some income taxes over here and you get a net income close to $8 billion. It doesn't get any better than this. When you pull it out for the 6-month period, paints an identical story off of $35 billion worth of revenue. Almost half of it flows down to net income. It doesn't get any better than this. Now you might be wondering, like, what does this company spend its cash on? Obviously, making the chips. TSM is a chip manufacturer. They own the fabs. They actually make the chips for Apple, NVIDIA. Pretty much every chip maker out there relies on TSM. So they are spending boatloads of money on property, plant, and equipment. And you see over the last 6 months, this company spent north of $16.7 billion on property, plant, and equipment. But folks, they had net cash provided by their operating activities at $24 billion. So they can comfortably spend this $16.7 billion on that and still have plenty of cash flows, plenty of profits. This is one of the best financial companies ever. And again, if it wasn't for those tensions with China, the United States, and Taiwan, and basically the whole Western world, I would absolutely own this stock, but there's so much uncertainty. I don't really want to own this and watch that play out. Also, if you own Apple, if you own NVIDIA, if you own pretty much any of the other chip makers, you're essentially getting exposure to TSM as well. So you don't necessarily have to directly invest in this company and kind of get exposure to how well run and how important this company is to the chip sector. Now, from a technical perspective, we are going to see this across the board with all these stocks. They are absolutely hanging on a cliff. We'll get to more of the broad view with TSM, but like the ETF that we looked at, it's in a downward channel. It broke out above that channel earlier this month and essentially has come all the way back and back tested this red line, the downward channel. Now, there should be some support on this one right at $78. If you're comfortable with the tensions over in Taiwan, you think they're overblown, they certainly could be. It could be just a bunch of smoke and a bunch of saber rattling by politicians and world leaders. Well, you've got a wonderful buying opportunity right here where the stock is right now at about $80 per share. When we zoom this one out, I'm going to give you a really broad view here, and this is on a weekly chart. If we go all the way back to the depths of the financial crisis back in 2008, this one has been on an elevator shaft upwards, and it just really has not broken trend since then. We're a little above this trend. It wouldn't surprise me even if this stock kind of breaks down below the area of support right at 80 and it gets down to $70, $75 per share. Still wouldn't be overly concerned with that because you have this longer term uptrend on this one. Now, the scary thing though is this volume profile, which we'll look at with all of these stocks. This is showing you there actually hasn't been a lot of accumulation of TSM over the last couple years. This is almost 2 years of sideways consolidation. And you see here, yes, this volume profile has stretched up. There was a lot of probably retail investors that accumulated this stock up here at 120. They are absolutely stuck on this stock, probably looking to dollar cost average down at these lower levels. But the problem is if you break this level at 77 and then we break this longer term, like decade long plus upward trend line, if you break that, I think it's almost certain, okay, a high probability. When we're looking at technicals, we're not dealing with certainties, we're dealing with probabilities. And if you break the first level of support here at about, we'll call that 75, and then if you break this upper trend line in short order, that'll be about $70 per share. You slice through both of those, there's not a lot holding this back from a volume perspective between about $75 and $60. You're coming down to probably at least 60 on this one, and then you can see representing on this volume profile, the biggest accumulation this stock has had is actually between $30 and $50 per share. That is a nightmare scenario for anybody that accumulated this stock up here at 120. This is some of the reasons why you might want to have stop losses on those. Now, speaking of stop losses, if you've bought into this one recently or if you accumulated this one at a higher price, you don't don't want to see this thing drop down to the $50, $60 per share. Well, I would have a stop loss probably somewhere on this upper trend line that we identified that is essentially going back to the depths of the financial crisis. If something like that materializes again, well, the momentum will just continue to push this one lower and lower. And again, that is the bear case scenario. I would actually expect, based on these financials, and if we assume that China is simply bluffing or saber rattling, that they'll overtake Taiwan and this company and this country can operate independently, these financials are so freaking good with this company. I would expect some footing to be held here, and you've probably got upside back to the bottom of this consolidation range up here at 109. Because remember, with this volume profile, you can slice through it on the way down, but you can also slice through it on the way up, and then you meet resistance when there happens to be a lot of buyers or sellers at that area. This one pretty comfortably, if you get a comeback in the markets, maybe an easing of the tensions between the West and China and Taiwan, this one comfortably could go from 80 back up to 110. So you've got some upside in this one. You've got a little bit of protection with these financials. Out of all of these companies, this one is the best from a fundamental perspective, but is absolutely the worst from a geopolitical perspective. And from a technical perspective, if you're comfortable and recognize those risks, the area that we're at, plus or minus another $5 to $10 per share, I would be comfortable accumulating TSM stock in this area. Next stock that we're going to look at on today's show, full disclosure, this is the one stock out of this group I continue to hold. I think you'll see some of the reasons why I continue to hold this stock. It might end up being a mistake, but I do continue to hold AMD at a lower price than where it is at today. Year to date, this stock's down big, over 46%. Over the last year, down 26%. Now, what separates AMD just a little bit is the fact that Wall Street has still really strong revenue estimates on this one for the upcoming quarters. For Q3, we're looking at about $6.7 billion worth of revenue. That's 55% growth. Some of that has the fact to do that AMD acquired Xilinx over the last year. So some of these revenues are including Xilinx, and it's comping against a company that didn't own Xilinx. So there's a little bit of that, but you still have 55% revenue growth for the upcoming quarter. You've got 47% growth for Q4, expecting $7.1 billion worth of revenue. Now, looking out into the future, really out into infinity with AMD over the next 2 years, essentially, you're looking at kind of like a low to mid-teens grower. And that's certainly not fantastic. It's not 30, 40, 50% growth rate, which we're used to with AMD and some companies in this sector, but it's certainly not bad. Certainly when we look at it, Intel and some of these other companies, even NVIDIA, they're starting to go negative on those revenue estimates. Now, from a valuation perspective, I've got a price to sales chart, a 10-year price to sales chart on AMD here. Now, this company was essentially a penny stock. It was left for dead until Lisa Su took over, and it was just transformed this company. She's one of the best executives in the world, in my opinion, and deserves almost all of the credit, in my opinion, for the transformation and the turnaround in this company. This company's trading about 5 times sales. You'll notice that compared to other chip stocks like a Qualcomm, like an Intel, 5 times sales pretty elevated, but you'll notice this is where the stock has traded at this level. I think more comfortably, this one probably get back down into a 2 to 3 times sales. That would be a bargain. So I don't think we're looking at a bargain valuation right now with AMD, but obviously this is looking back, trailing 12 months. If you look forward and you factor in the next 2 quarters of pretty strong growth, well, you're probably looking at a price to sales a little bit closer to that range. Always understand when you're looking at these valuation multiples, whether it's price to earnings or price to sales, you can look backwards. You can take the last 12 months and add all that up and get to a valuation, or you can look forward. You can look forward to the forward estimates. You can make predictions about the future and then assume a valuation going forward. I think with AMD, we're comfortable with where this company is at. Going forward, the valuation's probably reasonable. It's not a screaming buy. It's not wildly undervalued, but it's not egregiously overvalued like it may have been maybe about a year ago. Now, from a financial perspective with AMD, again, I've done a more detailed analysis of this company more recently. You can check that out down in the description below. But we'll take a look at the most recent quarter. We had $6.5 billion worth of revenue. We had $3.1 billion worth of cost of sales. So we get a gross profit of about $3 billion. In the most recent quarter, we saw gross margins flip. Last year, they were at 48%. Now they're at 46%. But year over year on a 6-month basis, you're right at about 47% gross margins. And if I recall correctly, the company is guiding somewhere in that range, those kind of low to mid 40s when it comes to gross margins for the subsequent quarters. Now, what blew up AMD's earnings was this research and development. It went to $1.3 billion in the most recent quarter. Last year was half of that at $659. You notice that $1.3 billion in the most recent quarter on R&D expenses actually exceeded the R&D expenses for 6 months last year. They spent just $1.27 billion on R&D for 6 months last year, and it ballooned in the most recent quarter all the way up to 1.3. That absolutely obliterated operating income. You notice that last year on a quarterly basis, you had $831 million worth of operating income. This year down to $526 million. So you had a compression in margin and an increasing in operating expenses that hurts your earnings per share. It hurts your earnings over at AMD. For the 6-month period paints a similar story. You're essentially flat on an earnings basis despite really strong revenue growth. You grew revenues over the last 6 months from $7.3 billion up to nearly $12.5 billion, but you're essentially flat, if not down, on the operating income and down on the net income side as well. Again, due to increasing cost, some of that related to the acquisition that AMD made as well. So definitely some things to like at AMD from a financial perspective, some things that probably could get better as well. Now, from a technical perspective, looks exactly like the SMH. It has been in a downward channel. It broke out of the channel in July and August and now come back and done a perfect back test on this channel. From a technical perspective, this is as textbook as it gets. Those of you that are new into technical analysis and new at kind of looking and analyzing at charts, this one has done exactly what it was supposed to do. It came all the way down and touched an area of support down here at about $75 per share. This stock has been consolidating at that low for over 2 years. Back in July of 2020, this stock broke above $75 per share and has retested it at least 4 or 5 times over the last 2 years, and it bounces like a basketball at that level. So we peaked out up here over $160 per share, came all the way back down, back tested 75, went back up and actually found resistance at a very critical level at $98 per share. It was initially resistance back here in February and January of 2021. It acted as support back here in August and September of 2021. It hesitated here for several months. Again, I'm on a weekly chart right here. Each one of these candles represents a week of trading. It hesitated at $100 per share. And then finally, once it broke down through that level, it retested that 75 level. Now it did a perfect bounce to resistance and then retrace back to this downward purple trend line. This, from a technical perspective, you could have traded this literally to the penny over really the last 2 years on this stock. Now, we should have some support here at 80. If the momentum stays out of these markets and these stocks, you should have some support right here at about $75 per share. That's only $5 lower. Now, when we stretch this out and we look at the volume profile, it paints a very scary story. And some of you might be saying, well, there's absolutely no way we slice through this volume profile and come down here to lower levels. You need to fast forward to the Intel segment of the show, because that is exactly what Intel has done. It has dumped out the bottom of a multi-year consolidation. In fact, a longer consolidation range than AMD has been on, and it dumped all the way down to an area of demand on the volume profile. If AMD were to do that, the next stop, again, if we break lower than 75, and I would say it's probably significantly lower than 75. In fact, we've got a small area of consolidation right here. The worrisome area for me with AMD is if you get down below 75, you're probably in very short order coming to about $60 per share on this one. I wouldn't necessarily be completely alarmed if this stock does that, but I wouldn't blame an investor putting a stop stop loss on this one, probably right at about $68, $69 per share. You wouldn't want to get south of that because then you're retesting this small area of consolidation. The momentum stays out of AMD and you're getting much, much lower. You're probably retesting these areas at about, $30, $40 per share, another 50% retracement on this one. So in the shorter term, if the bear market remains, if all the bear cases and all the bear news continues to create selling pressure in the stock, if the liquidity drained by the Federal Reserve continues to drain liquidity out of this market, I think it's a decent probability you retest $40 or $50 on AMD probably by the end of the year. So you've got 50% downside in this one. And I think your upside is simply retesting this $100 area, because when we looked at the earnings estimates on these ones, it's going to slow down into next year and 2024 that I don't necessarily think investors are really going to want to pay a premium multiple for a company that's only going to grow in the mid-teens. So I think you've got upside from about 75 to 80 up to 100. That's roughly 25% upside. And you've got nearly 50% downside in this one. That risk reward is not a fantastic setup. So just me personally, I wouldn't make this kind of a something I accumulate rapidly over the next 2 to 3 quarters, because I just don't see necessarily the upside to push this back up into the 120s, 130s, 140s, unless this company makes another acquisition or somehow is able to re-accelerate its revenues back into those 20, 30, 40% range. My outlook primarily for this sector, but also AMD, is we probably find consolidation ranges somewhere in this upper region between, I would call it about 60 to 65, up to about $90 to $100 per share. That's a pretty wide consolidation range. And if that gets predictable, you can play that chop from a shorter term perspective, but also a longer term investor can accumulate at those prices, assuming that AMD eventually reaccelerates those revenues into the future. Next stock that we're going to look at on today's show is we'll take a look at Intel. Now, obviously, I've posted videos in the past. If you're a fan of the channel, you know, sometimes I go a little over top with my Intel videos. That is because in the comment sections, people very passionately defend this company and often take personal attacks at me. And newsflash, I'm from Stockton, California, and the MO of people from Stockton, California is we don't take crap from anyone, and we will dish it right back to your face when the stock that you defended is down over 41% over the last year, and year to date down about 41% as well with Intel. This stock has completely fallen off a map, and this is a very, very cautionary tale that if this sideways consolidation, this was a 4 or 5 year consolidation pattern that we were making on Intel, it broke, and you see what happens when sideways consolidation breaks. You go from $45 per share down to 31 in the matter of just a couple of weeks. We'll get to the technical chart here in a moment when it comes to Intel. But first couple things that I want to talk about is this company released their earnings back in July. They had revenues coming in at about $15.3 billion. They revised their full year guidance for $65 to $68 billion worth of revenue. Consensus estimates was closer to $74 billion. So they came way underneath this, and this stock took a gigantic dump on the news of these earnings. In fact, it was down over 8.3% on this news. For the Q3, the company projected $15 to $16 billion worth of revenue. This is the revenue that we're expecting when this company reports their earnings probably next month, or maybe even later this month. We're expecting revenues between $15 and $16 billion. The problem was Wall Street was expecting $18.6 billion worth of revenue. Now, we'll come over to those revenue estimates, and what you're going to see here at Intel, it'll match what you're going to see over it in NVIDIA. Now, you are projecting negative growth for the next 3 quarters. That means the next 3 quarters, almost a full year, you're going to have revenue that is going to come underneath where you were the previous year. And then when we come over here and look at the financials, you're going to see that this quarter actually was negative growth. So Intel has been on a negative growth from its revenues for several quarters now. That is a problem. And I don't care if you're looking at Intel or you're looking at any stock out there. Any stock that has negative revenue growth is not, I repeat, not going to get a premium multiple from Wall Street on those sales and this stock, because there's going to be a lot of people in the comments, and a lot of people have made this argument over really the last 5 years with Intel, is they're going to say, well, the price to earnings is only 13. We'll come over here and we'll look at the price to sales. The price to sales is on literally a great financial crisis level, under 2 times sales. There's going to be people out there that are going to say, oh, this is a screaming buy. Guys, Wall Street just simply does not pay a premium for companies that have negative revenue growth. But there's your risk reward, okay? If you believe Wall Street that this company somehow magically in June of 2023, so about a year from now, this company is going to be able to reaccelerate to 9, 10, really kind of a low teens, high single digit grower for the next couple of quarters. And obviously that can be believed because we've had such disastrous results over the last year or so with Intel that it's entirely possible that they lap those results and then able to achieve a little bit stronger revenue growth. But again, there's going to be a lot of investors out there that don't really buy that and don't really care. Now, a lot of the noise around Intel is the fact that they're going to build these chip plants. I think they've got one coming up in Arizona. They've also got funding for the one in Ohio as well. There was a lot of hoopla around that CHIPS Act bill that was passed earlier this year here in the United States. It's going to provide tax subsidies and even grants, just free money to these companies to build these factories. Now, I'm not on here going to argue the political side of that. That bill is signed. It's into law. That is a fact. That is cool with me. But what I don't think investors really understand is Intel is not going to wholly own those chip factories. Take a look at this. So they've signed a $30 billion funding deal with Brookfield. Brookfield essentially going to be their infrastructure partner. They're going to pony up $30 billion. And when I say they, I'm talking about Brookfield. They're going to build this factory in Arizona. Intel is going to own 51%. Brookfield is going to own 49%. So they're going to be a minority owner of it, basically just providing some fundraising for it and going to allow Intel the leeway to operate it since that's in their expertise. But I don't think a lot of investors understand this, okay? The fact that Intel's CFO, David Zinsser, said that the companies will split the revenue from the factory. I think there's a lot of Intel bulls out there that think they're going to build these factories and it's just going to print money and all of a sudden they're going to start looking like TSM from a financial perspective. They are going to split the revenue from this fab factory. I would assume also when we start looking at that Ohio factory, which again is probably 5 or 6 years, maybe even longer than that from actually producing any kind of revenue, they're going to likely have to split or carve out some of that revenue as well. So just keep that in mind when you see all the news story around Intel building these fabs and how maybe that'll turn them into kind of the American TSM. That is certainly possible, but they're going to split the revenue from that Arizona foundry with Brookfield Partners. Quite frankly, maybe this ticker symbol BIP, maybe that's the better investment than Intel, because as we move through this, we'll see Intel on a price to sales basis is just trading at a fraction time sales, just 1.8 times sales. Now look, over really the history of the company, really over the last 2 decades or so, this one hasn't traded north of about 4 times sales. In fact, anytime it's gotten north of 3.5, 4 times sales, it's instantly been a sell with this stock. And it hasn't been really south of about 2 times sales since the great financial crisis back in 2008, 2009. So from a price to sales multiple at Intel, it really doesn't get any better than this. But again, we're looking forward with the revenue estimates. They're going negative. And then we also have the fact that this company is pivoting their business to a certain degree. It's not a full pivot, but they're pivoting to kind of a foundry model where they're only going to own half of the revenues that come from that business. Just something to think about as an investor. Now, the most recent quarter, again, this was back in July, was a disaster. You went from $19.6 billion last year down to 15.3. Gross margins just shriveled up. Look at this. Here was our biggest problem with Intel, and this is why I would not invest in this stock. Look at your cost of sales. So your revenues declined from $19.3 billion or $19.6 billion down to this 15.3. You shed off over $4.3 billion worth of revenue over the last year on a quarterly basis. But look look at your cost of sales. They actually went up. This is really, really bad. You went from 8.4 all the way up to 9.7. So look what happened to your gross margin. Last year, you had $11.2 billion worth of gross margin. Now just $5.5 billion. Yuck. Look at your research and development. That went up from 3.7 to 4.4. Your marketing and general administrative went from 1.6 to 1.8. So you guessed it, your operating expenses went up as well. So your cost of sales went up, your operating expenses went up, your revenues went down. A lot of you are going to be able to connect the dots. Your operating income got obliterated. Last year, this company made $5.5 billion operating income. This year, they lost $700 million. When you couple this with the fact that this company is projecting negative revenue growth for the next subsequent 3 quarters, there's a lot of investors saying that, yeah, I'm not paying a high multiple on these sales because look what happens when you have negative revenue growth and increasing cost and expenses, you get obliterated from a profit perspective. This company actually lost money in the most recent quarter to the tune of 11 cents per share. Last year, they made $1.24. Now, from a balance sheet perspective, they can afford it. This company can wade through some bad times. They certainly can do that. They probably have years of cash on hand, over $22.6 billion. And again, if they're partnering with other investment partners on those fabs in Arizona and Ohio, they probably can wade through it even longer than that, where they're not putting up forth all the money. And they obviously have assistance from the United States government as well. They've got over $22.6 billion in cash, although that's going to continue to get weeded down over the next couple of months and quarters ahead. Debt coming in at $32 billion. They've been whittling that down. When you come down here to cash flows, when a company loses money from an operating perspective, you always want to come down to cash flows. We've got 6 months ended with Intel. Notice last year they had over $14 billion with a positive cash flow, all the way down to $6.7 billion. Yikes. And look at this, plant and property and equipment. They spent over $11.8 billion on that over the last 6 months. So it's a disaster when it comes to cash flows over at this company. They're burning through lots of cash. They're still paying dividends to shareholder. Over the last 6 months, they paid nearly $3 billion worth of dividends. They decided not to buy back the stock over the last 6 months. I think that's a wise move, although they could have used that money last year when they were buying the stock at a much higher price, including 50% higher. They did $2.4 billion worth of buybacks last year. I personally think I would get excited about Intel. Number one, if they can start proving that these revenue estimates might go positive sooner rather than later. The other thing I'd get excited about this company is if they end the buyback and they end the dividend. They've got to cut this out. It's not doing this company any good. I would cut it out. If this company is really confident about the foundry model that they're working on, they should be reinvesting this money instead of paying shareholders. They should be reinvesting it in the business model. And then finally, they repay debt. I don't really have a big problem with that because this company might need that money sooner rather than later. Now, here's the ugly part. Not only when it applies to Intel, but when we're looking at AMD, TSM, NVIDIA, all these stocks really were on this shelf when it came to sideways consolidation. This stock for over 5 years, from November of 2017 till just more recently, just a couple of weeks ago, quite frankly, this stock was consolidating between 44 and kind of the low end consolidation up to about 52. Now, you had some times when this stock traded a little bit higher, up to about $60, $65, $68 per share. Nobody pretty much accumulated the stock at that level based on this volume profile that we see here. Everybody accumulated this stock in these tight bands between 45 and 50. That is what's troublesome and worrisome when you look at an Intel, in the fact that it just more recently sliced below that area consolidation. And when these stocks slice below, look how fast and quick and violent the drop is. This is a complete deterioration of this stock. And in fact, it blew through an area right here at about $35 per share, which would have made a ton of sense that it would have made a pit stop here. No, it just sliced right through that. That is very worrisome, but in the shorter term, this stock, it should find some footing. And I think in the shorter term, there's probably some great shorter term trade opportunities. If you see this stock make a reversal down here, it would basically be some higher lows, maybe kind of a U-shaped formation on the price action. Well, you should have a rebound. This $35 35 level on Intel should act as some kind of magnet to price if this stock is able to turn things around in the shorter term. If this momentum in this name remains negative, you're coming south of $30, and that's not really saying a whole lot on this stock since it's at 31, but you're probably coming south of probably 25 on this stock very, very soon. Obviously, the stock pays a dividend, has a pretty healthy yield at this time, 4.68%, but I think at some point investors are going to question if this company is going to be able to maintain that dividend yield. Now, there's a lot of risk that has been drained out of Intel, so I totally understand that argument. If you get in the comments or you make this argument on your own and you buy Intel and you say, look, there is so much risk that has been drained out of this stock that for this stock to go down another 30 or 40% would just drain that out even more. You also have increasing volume on this stock as well on this way down, so you have an increasing selling, increasing panic on this type of stuff. There is absolutely some risk reward when it comes to Intel. Me personally, I don't want to touch a company that has negative revenue growth over the next couple of quarters. And I don't believe where we sit today that this company is going to be able to reaccelerate it to kind of a mediocre low teens, high single-digit growth rate for the next 2 years. It's just simply not good enough, especially when there's a lot of other stocks out there that have higher revenue growth, higher profits, higher cash flows, less questions about their business and less questions about their future, and don't have to partner with people in order to execute that future vision. Intel remains a no touch for me. Next stock that we'll cover on today's show is NVIDIA. Year to date, this one's been slammed down over 54% over the last year. This thing's down 39%. We still have a gigantic, I'm talking about a gigantic $340 billion valuation on this one. Now, the problem with NVIDIA obviously is twofold. You had those gaming chips, which we saw the demand for those start to shrivel up as a lot of people maybe picked up the gaming chip that they wanted over the pandemic as they were sitting at home. We also had crypto miners use a lot of those chips to mine cryptocurrency. Obviously, the air and the balloon has kind of been left out of cryptocurrency. Now, that obviously can turn into a tailwind into the future. You've got gamers that may come back and maybe try to upgrade their system with the new and latest, greatest chip that NVIDIA is working on and is going to release. You also have maybe a tailwind with cryptocurrency where it maybe goes through a period of time where it consolidates around a little bit lower prices and then maybe makes its next leg higher. We'll see when and if those things materializes. Obviously, depending on where you fall in that spectrum on when crypto comes back and when the gaming, actually physically playing the video games, when that comes back to NVIDIA, when does that come? I don't know. We'll see Wall Street estimates here in a second, but we had revenues come out. Now, NVIDIA pre-announced their revenues. I believe it was in the beginning of August. And then when they came out in August of last week or about 2 weeks ago, it was actually even worse than expected. Revenue came in at $6.7 billion. That was just 2.9% growth. Folks, we have a 40 PE on this one. You cannot grow at 2.9% year over year and have a 40 PE. We've seen what happens with stocks that do that. They'll get obliterated 100% of the time. We also got Q3 outlook, and I'll give you a note about this Q3 outlook here in a second, but they came in at $5.9 billion. Again, we just printed a quarter at $6.7 billion. So sequentially, quarter over quarter, we're going to go from $6.7 billion all the way down to 5.9, but it's going to get worse. I'll show you here in a second, but I do want to point out that Wall Street was expecting sequential growth to $6.9 billion. So we were expected to go from $6.7 billion in Q2, grow to 6.9. We're in fact going to go from 6.7 down to 5.9, but that is before the United States banned some of the sales of NVIDIA's popular AI chips to the country of China. NVIDIA released a note that they're going to see another $400 million shaved off of their revenue in the upcoming quarter. And as long as that ban is in place, it's my understanding by reading analysis that it's likely going to be a $400 million hit for the subsequent quarters as well. So we're not going to print $5.9 billion in the upcoming quarter. It's probably going to be a number closer to $5.5 billion. It just gets worse and worse and worse for NVIDIA. That is why the stock continues to go down. Now, like Intel, this stock is going negative from a revenue growth perspective for the subsequent quarters, and I don't think these revenue estimates are low enough. We're seeing in the upcoming quarter, Wall Street coming in right at $5.9 billion. Again, that was the guidance we got just a couple of weeks ago. Wall Street taking a 3-day weekend. They're going to take their time revising these estimates since that news of that China ban just crossed this week. We are going to see this revenue estimate probably coming in at about 5.5. I see on the low end, that's where the revenue estimates, that's where this is going to be. So you're not going to decline 17% year over year. It's probably going to be a number closer to 20%. And I think the subsequent quarters are going to have to come in as well. I'm seeing revenues north of $6 billion. My guess is the upcoming quarters probably has a high probability, at least the Q3, coming in under $6 billion as well. Now, here's the problem with NVIDIA. Wall Street expects this company to somehow magically, now NVIDIA is on kind of a funky fiscal year quarter. They look at next year as fiscal year 2024. It's really October of 2023. So this time next year, Wall Street's expecting this company to grow 39% and then another 39% in the fourth quarter. And then subsequent quarters, kind of high teens, maybe as high as 22% growth. I don't know if anybody believes that at this point. Obviously, if NVIDIA is able to pull this off, stock's probably undervalued, probably will rally into next year. But the point with NVIDIA is these estimates are still probably too high. We're going negative. We're going Intel-like negative on those revenue estimates. I don't think Wall Street's going to like that. On top of that, you have a price to sales multiple. And again, this is trailing 12 months. So you can either look backwards and look at the last 12 months of revenue that NVIDIA has gotten. Now, obviously, that doesn't factor in the fact that this company is starting to revise down future estimates based on the demand of their chips is a lot different this year than it was last year. And then obviously you have that China news as well. The subsequent couple of quarters for NVIDIA is going to be a disaster compared to the trailing 12 months. So right now, the trailing 12 months price to sales is at 13. If you look forward, it's probably actually closer to 20. That is not a bargain. When you're looking at Intel trading at close to 2 times sales, when you're looking at AMD trading at about 5 times sales, TSM trading right in that 5 times sales as well. We'll look at Qualcomm here in a minute. That stock also trading south of about 3 or 4 times sales. This stock is still wildly overvalued from a sales perspective. And if they do not magically reaccelerate their revenue a year from now, this stock is just going to continue to fall. I repeat, I would not touch this stock because the valuation is still absolutely insane. We see that from the revenue estimates. We are basically flat on a revenue perspective year over year on a quarterly basis. You went from 6.5 up to just 6.7. Look at the cost of revenue. This is exactly like Intel. Although our revenues didn't go down, we'll see this in the next quarter. We'll have declining revenues, and my guess your cost of revenue is going to go up because what NVIDIA is having to do is because they are seeing demand shrink for their chips, they're still having to pay TSM for the slots that they reserve. So what these companies do is they actually have to pay somebody like TSM. They have to pay them up front saying, hey, will you make these chips for us? And then all of a sudden NVIDIA's like, uh-oh, nobody's buying our chips. But guess what TSM's going to do? They're still going to collect their money. So that is going to drive up cost of revenue while your revenues continue to shrink, go sideways, and go down. So you notice over the last year, you went from $2.3 billion worth of cost of revenue all the way up to $3.8 billion. Your gross profit shriveled up. This is Intel, like you went from 4.2 down to 2.9. Your research and development cost ballooned from $1.2 billion up to $1.8 billion. Your selling general administrative remained relatively flat. That's compliments to management. They did a nice job there. But your total operating expenses over the last year went from $1.7 billion to $2.4. So when your gross profit shrivels up by over $1.3 billion and your operating expenses grow by $700 million, your income from operations is going to get obliterated. Went from $2.4 billion with a positive operating income last year all the way down to almost break even, basically a rounding error, right at $500 million. And you have to imagine the subsequent quarters are not even going to be this good. I think this company is actually going to have a net loss and a net operating income loss for at least the next 2 to 3 quarters if the demand stays out of those gaming chips and the data center doesn't make up for that. this company is going to struggle. And we see evidence of that when we come over here to the stock chart. This is Intel like before it dumped out the bottom. This is the worry that a lot of investors have with this stock. The fact that you still have a gigantic price to sales, a gigantic price to earnings. You have negative revenue growth. You're going to have earnings turn negative, operating incomes turn negative, gross margins go in the wrong direction at this company, and it is still holding this premium level. Normally, if it was just a general broader market sell-off on this stock, I would tell you right now, pile into this company, get as many shares as you possibly can. This is where you accumulate. No, that is not the case here. This is why we always take the complete picture here on the investor channel. We not only look at the fundamentals, we look at the most recent quarter, we compare it to the past, but we also look forward to the forward estimates. We look at the broader sector as well, the broader economy. This thing is probably going to continue to get worse before it gets better. I would be shocked. I would be shocked if this company holds this level at about 120, 130, whereas I thought maybe, quite frankly, maybe just a couple of weeks ago that it would get into this area. I mean, we've been saying for months and weeks now that this stock would get into this area and we would buy it, but we have to continue to adjust to the information that we're getting. And I'm going to zoom this out and show you this volume profile, and it is scary as all heck. Look at this. Nobody, I'm telling you, nobody accumulated this stock north of about $75 per share. This is almost all retail investors accumulating this stock really late in the game after the monster run that this stock. The accumulation for this stock actually occurred south of $70 per share. That is over 50% decline on this one. And that is what I am projecting with NVIDIA. I am projecting another 50% drop in this stock at least, and probably in pretty short order. I would guess over the next 3 to 4 quarters, it would be surprising to me if this stock doesn't come to about $70 to $75 per share, which again, not quite a 50% drop on this stock, but very, very close. That would take your price to sales multiple closer to where the industry is. It would take your price to earnings multiple closer to where the industry is. It would reflect the fact that you've got negative growth and negative trends at this company from an earnings, a profit, and a margin perspective as well. I am sorry to be the bearer of bad news. If you don't believe me and you're like, this guy is full of it, that is your risk reward with a stock like this. That is your risk reward, because there's going to be a lot of investors that see this the same way as I do. And I have a track record of accurately predicting NVIDIA's price, because when you look at this volume profile, again, a lot of retail investors, and unfortunately a lot of people watching this video, and I'm not trying to rub it in, probably accumulated this stock at these higher prices. I'm going to show you I accumulated this stock at the proper area. This was back in 2018. Here's my IRA account. I bought just 10 shares, or almost 12 shares of this company at about $40 per share. Again, that is in the area where the institutional and what I would refer to probably as the smart money accumulated this stock in this $40 to $50 range. And then what did I do? It ran up, and I didn't sell it at the highs, but I sold this one at 210. That is up here. When this trend reverses, that is when I got out of this one. So it was a fantastic trade. I made a ton of money on this one. It dumped into my IRA account. You're only allowed 6,000 deposits in an IRA account, and I turned about $488 into over $2,000 in just a couple of years. If I can keep doing this, I probably will retire from this channel at some point. Not saying this to rub it in, but this is my view on NVIDIA. I was right on the way up. I was right to get out of this one when the trend reverses. I didn't get out at the top. I didn't buy at the bottom. That is not my goal. My goal is to avoid these gigantic givebacks. And I think that's what we're on pace for when it comes to NVIDIA. The last stock that we're going to cover on today's show, we'll do a little bit more in-depth video on Qualcomm, since I did not review them on our most recent kind of earnings season that we had over the last year. The stock's down only 11%. Year to date paints a little bit different story, down about 31% on this one. Now, this company is making deals with a lot of different companies out there, but they just partnered with Meta, otherwise known as Facebook, to develop more VR headset chips for those devices that Meta seems to believe millions and millions of people are going to strap on their faces and use on a daily basis. Now, Qualcomm also reportedly entering the server market, which quite frankly is probably bad news for NVIDIA and the rest of these stocks that sell into that server market, because that's probably going to keep margins and revenues down a little bit. And they're apparently trying to court Amazon to be a potential customer. My guess is they'll give incredible pricing to whatever customer decides to come in at the early stages. Now, this company released their earnings back on July 27th. Revenue came in at $10.9 billion, still spectacular, 37.3% growth rate on that one. They saw their Q4 revenues expected to between about $11 billion up to about $11.8 billion. Wall Street was expecting closer to the high end, in fact, just a little bit above that at about $11.86 billion. So they came in underneath it, but not quite as bad as Intel, not nearly as bad as NVIDIA as well. So this stock has held up relatively well since reporting their earnings, although it's slid down like the rest of the sector. Now, when we come over here and look at these earnings estimates, we're expecting $11.4 billion worth of revenue for that upcoming fourth quarter. Again, that's basically the midpoint between the guidance that Qualcomm gave. That would be 22% growth year over year. Fourth quarter, or actually the first quarter of next year, expecting about 14% growth. But then what I noticed with Qualcomm is we're basically just going to go on life support for the next couple of quarters when it comes to revenue growth, essentially not going to grow. So that is a problem. I wouldn't necessarily pay a premium multiple for I definitely wouldn't pay a premium multiple for Intel and NVIDIA, which are in decline mode. I also wouldn't pay a big premium multiple for a stock that's basically going to go flat over the next, really into infinity with this one out into 2024, calendar year 2024. You're not expecting a lot of revenue growth for Qualcomm. But the good news is you're not paying a wild price for this one. I've got a 10-year price to sales chart on Qualcomm. Right now, you're trading at about 3.5 times sales, which is way underneath where NVIDIA is. It's not quite as low as Intel. It's lower than AMD. It's probably lower than the broader sector as well. But you'll notice there are areas where when this stock gets south of 3 times sales, it's touched that twice over the last couple of years, probably on the Powell pivot back here, but then also kind of a pandemic lows as well. We're not far from there as well. So if you buy this one based on that reasoning, probably not that bad. Now, from a cash perspective, this one's not as great as some of the other stocks in this sector. We do have some cash on the balance sheet, but it is kind of bled through a little bit. We have a fair amount of inventory as well, although it might not be that comparable. You get kind of a 9-month view. You're not really comparing year over year. You're comparing last September to this June. You went from $3.2 billion worth of inventory all the way up to $5.4 billion. You don't got a ton of long-term debt on this one. So despite kind of a little bit lower cash balance sheet on this stock, the debt isn't huge on this one. So from a balance sheet perspective, it's not perfect. I'm not like 100% comfortable with it, but certainly nothing to be really that concerned about when it comes to this company. And then when we flow through these earnings, you'll see that this company really does print a lot of money. So we had revenues in the most recent quarter coming in at that $10.9 billion. Last year, you were at 8. Really explosive growth. But then again, I'll remind you, for the subsequent quarters, we're going to be plus or minus $1 to $2 billion to where we are right now. So we're at about $11 billion worth of revenue. For the next 2 years, you're going to be at about $11 to $12 billion. So what you see is probably about what you get when it comes to Qualcomm's. You've got cost of revenues, inching up, research development, inching up over at this company. Total cost and expenses over the last year went from 5.8 to 6.4. That will be the challenge at Qualcomm. They are going to have to maintain these costs and expenses. Otherwise, obviously, when you're not growing your revenue, if your expenses start to continue to grow and maybe they exponentially grow, well, that's going to shrivel up your net income, just like we've seen over at Intel, just like we've seen over at NVIDIA as well. So your operating income over the last year, beautiful. Now, they had this kind of other income that they were able to recognize. Even if you strip that out, this $1 billion, you still got really strong operating incomes over at this company, $2.2 billion up to about $4.5 billion as written, minus some one-time things, and you're still up over to $3.4 billion operating income. Net income looking beautiful, $2 billion up to 3.7. I love these financials, and I love the fact that this company doesn't trade at a premium multiple. These are really solid. Would I center my entire portfolio around a company that is not projected to grow from a revenue perspective and likely probably going to meet some headwinds from a margin perspective, from a cost perspective? I wouldn't center my whole portfolio around that. but there is some margin of safety when it comes to these types of stocks. Now, from a cash flow perspective, paints a little bit different story. You went from $9.4 billion on the 9-month ended last year down to about 7.6. They don't have a lot of capital expenditures over here, okay? When you look at like Intel, they're just spending tons of money on these types of things. Not as much over at Qualcomm, okay? Just $1.6 billion in the most recent quarter. So they don't burn through a lot on those investing activities. They did some refinancing in the most recent quarter. They took on some short-term debt. They basically repaid it, hopefully at a lower interest rate. They did the same thing on the long-term debt side. They basically took out a loan to pay off another loan. They are doing a share buyback. So when a company essentially kind of goes flat to negative on the earnings side or the revenue side, well, doing a share buyback can be a positive thing for investors, especially if you believe on the other end of that kind of flattening period, maybe they reaccelerate it back up into the high single digits, low teens. And obviously you're getting a dividend as well on this one. We've got about a 2.3% yield on this one. You get about $3 per share when it comes to that dividend. Now, this stock, again, looks like every single other one of these stocks, including AMD and TSM. You have this longer sideways consolidation chop. This one's been going on for almost 2 years now. The bottom end of the range is right here at 122. So from a technical perspective, this has been a buying opportunity for the last 2 years with Qualcomm. You could buy it here at 122. I would probably take profits on a stock like this, at least maybe on a port. Like say I buy 10 shares at 122 and I get a rally up to the 140s on this one. Maybe I sell them all, but if you don't want to sell them all, maybe collect some of those dividends. Maybe I sell 20%, 30% of whatever I bought down at that lower price. This is an area, but like you've seen here with the rest of these stocks, is if they dump out of the bottom of this range. Okay, we saw it with Intel, and the setup is certainly there with AMD, NVIDIA, TSM, and the rest of these stocks. If you dump out the bottom of this sideways consolidation, it's called look out below. Because look, nobody has accumulated this stock. Really, quite frankly, over $92 per share, there is almost zero volume accumulating this stock. This is almost all retail investors piling into this name, over $92 per share. But more specifically, south of 124, between 124 and $90, literally nobody has accumulated this stock. So if you break this 120 level, and that is why this stock gets defended at this level, and this goes for all of these stocks at this bottom end of the consolidation range, the reason why it gets defended so well at that level is if it breaks that level, you are coming down at least to about $90 per share. Again, that is not certainty, but it is a wickedly high probability on that one because you are going to have so many computer algorithms. You're going to have so many professional traders take the short side in this name if it starts slicing through the sideways consolidation zone. I have seen in very few years of me looking at stocks over the last 2 decades, I've seen very few stocks break a consolidation range like this and then somehow find footing where there's no volume. You can just pull up the Intel chart, which we looked at earlier on today's video. It slices through this area. And then what happens is you've also got an acceleration of momentum. And then you also get panic of these retail investors that bought this one north of 120. So you typically get a huge acceleration down to at least kind of the midpoint of the volume profile, which would take you about a 50% retracement on this one. I think your downside on this one is 50%. And I'm not saying that as that has a decent probability of actually happening, okay? And your upside is from about 120 up to maybe the top end of this consolidation range at 150. And I'm just thinking to myself, how is a stock that is not going to grow its revenues for 2 years and probably going to see margin compression and pricing power compression and probably see a disintegration of their cash flows and probably see a disintegration of their operating income? How is a stock that is not going to grow its revenue and probably going to see shrinking revenue growth, how am I going to push back to a more premium valuation? I don't know if that's really going to be in the cards for Qualcomm. So your upside is somehow the market pays a larger multiple for shrinking sales and shrinking profits, or maybe at the very best kind of flatlining on revenues and profits. How are they going to pay a bigger multiple on that one and push the price up back to maybe 160 and your downside is over 50% more? I don't think the risk reward setup is here with Qualcomm. I don't think you need to be a rush in to accumulate this stock. On other videos that I've posted, I think there is more of an urgency to accumulate stocks. For most of this sector, most of the chip sector, I don't necessarily see an urgency to accumulate. Can you have some pops and drops? Can this one recover in the shorter term? Yeah, probably so. There's going to be some dip buyers in these names. But when we look at the fundamentals, when we look out into the future, when we look at margins, when we look at profits, they are likely not going to be able to reaccelerate or recover for at least a year. And if that gets even worse, if we have to start looking 2 years, 3 years out for a recovery on margins and revenue growth, well, this thing is not, I repeat, and not going to push higher. I think there's other sectors and other stocks I like way more than this sector. I will obviously be covering those videos and those stocks in the future. If I am completely wrong about this, that is your risk reward on this one. This one would violently move higher if these companies can reaccelerate the revenues, reaccelerate profits. This sector and most of the stocks that we talked about on today's show, in fact, all of these stocks, if they are able to reaccelerate revenue growth back to at least the mid to high teens, maybe 20% growth, and they're able to reaccelerate margins and reaccelerate profits, this sector is probably going to skyrocket. I just don't think that is going to happen in the shorter term. But if I change my mind and if the news starts getting better, I obviously will come back on here and update you, and I will be buying these stocks hand over fist sometime in the future. Hopefully you guys enjoyed today's video. Thanks so much for tuning in. We'll be back again soon. Good luck with your investments.